All right, so we're wrapping up our family vacation here in San Francisco, and considering the volatility of late last week and heading into this week, since we did our Market Outlook webinar on Wednesday night, I thought, well, we'll take another day out here and update everybody on what's going on in the markets with a kind of impromptu Market Outlook video from, foggy San Francisco. I'll send the family out to Golden Gate Park, and I'm looking at the markets here, and I'll give you over the next little bit longer video than normal, but give you a little update on what's going on, what I'm thinking, what I'm expecting going forward into the rest of this week and beyond, and then what you can do about it. So let's go ahead and get started. Today is Monday, August the 5th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. You can see our intermediate line now has dropped below with today's drop. So we've had 4 days in a row, 5 days, well, actually 6 down days in a row now on the S&P 500. The sixth day getting down to the lower end of this Fibonacci retracement zone of this intermediate run that we've been on since that low point, May 31st low point. We've pulled down to the bottom, and of course in the after hours, we'll talk about more of that here in a minute, but the after hours are below that even. We're down closer now towards those lows. Again, keep in mind, how things move. It's far more bearish to have moves during the market than in the after hours market. So we'll keep our eyes on that. Coming off the lows kept the short-term sentiment from being too extremely bearish. So again, as bearish as this is, interestingly enough, our momentum line and near-term line is in the lower reversal zone, but you notice it's not even as low as it got over here on these 2 down days. Kind of shows, again, because we keep closing off of the lows, the short-term sentiment avoids these big down moves, whereas on these days we close at the lows of the day. But again, the intermediate posture is now strongly bearish. We have a dark pink shading and a dark red line. That combination is bearish. We don't have falling market sentiment yet, but that combination is, from an intermediate standpoint, pretty bearish. So needless to say, right? Obviously, I think anybody and their dog can tell that we're bearish, but we broke through the 38% Fibonacci retracement from Friday's close, and now sitting on the bottom end, like I said, with more downside here. These lines, as you can see, the red lines come from the market sentiment low point. So the red lines are the current market sentiment rally off of basically that Christmas Eve low. It's actually the next day where we hit a lower intraday low point. We were just sitting at the 23% Fibonacci retracement. We've gone a little bit below that, and you can see where the 38% retracement lies here at 27.68, just up above essentially this old low point from early June. So you can kind of see where the lows and the supports are. You go to the Bollinger Bands for SPY. Again, we went through that. That's how significant. Again, I mean, we just don't break support with barely any kind of moves. I mean, that was a significant sell-off today, and you'll see here how extreme it was, breaking through the 62% retracement level on the Fibonacci fans even, and dropping down through a major support level from a volume standpoint. That's why today seems so extreme, because we dropped through such a major level of support, filling in this vacuum, coming down to this 280 level now, where the next layer of support is. You can see we had multiple touches over here. We kind of traded in that range over here back in late March. Went through it a little bit. We were trading there in late May. Then we had this kind of last little sell-off to May 31st. And then now again we're here. So 280 appears to be another layer. And again, we're at 283. Is where we closed today, but if you look in the after hours here for SPY, you'll see that here. Let's zoom this. I'm on my laptop on vacation here, so I don't have quite the same. It's not as easy to look at But you see 278.5 is where we're at right now. So that's actually down into right in this area. So we're sitting right in this zone of volume, trading in that zone, seeing if, because if we don't hold this layer, then there is no support to the downside. I mean, you have a little bit of a support right here at 265, but after that, it's all, we're through the biggest levels of support. So things can get a lot worse. As bad as it seems today, things can get a lot worse if we hold up. Now, I did tweet out today here. Here we go. I did tweet out earlier today. Where is it at? Right here. How bearish today was a 2% day. Usually when you get these big down Mondays, it can lead to large weekly shadows. So when I look at the weekly chart here, you can see that let's go to a 5-year weekly chart. You can see where all this volume is below us on the last 5 years. So again, it's not, we've got a lot of support here on a weekly basis going back more than 1 year. But you break through this level here, and really it's probably about 265. Then it's a little bit of free falling all the way. There's not very much volume, little bits of volume in these areas until you get down to this 205. That's how significant that run was after the election in 2016. We went up with so little volume in 2017 that we weren't able to really set some good support because it was so little. And now you can see we were up so much, kind of extending away from that support and now pulling back down towards it. So you can kind of get an idea. But when you get those long here, let's get rid of this volume profile, this probability cone. There we go. And for that matter, let's go ahead and get rid of the volume profile as well for now. You get these long lower shadows when you start off the week as bearish as we are. Because again, consider, when you finish the week at the low, obviously the low is at the end of the week. When you get the long lower shadows, that means usually the low is towards the middle to end of the week. And if we get a long lower shadow with kind of a little bit of a hammer pattern, less of a body, something like this over here, July of 16, that means the low was pretty early in the week, relatively early in the week. Or like here, especially in August 15, a lot of people are comparing this to August 24th of 2015. That was, let me go back over here. Here we go. That's on that list. We were down 4%. August 24th of 2015. We were down another percent the next day. The next 1 week later, we were up 4%. A month later, up 2%. A year later, up 15%. With the worst drawdown being another 4%. So that kind of gives you an idea of how bearish. And you can also see, I don't believe it was on this. Yeah, here it is on this list too. At 2%, at least a 2% down. They remember it was almost 4% after three straight. 0.75% essentially down days to finish the week prior. So it was even on this list. That's how significant that week was. And again, Monday was really bearish, and that's how the candle ended up looking. We ended up getting back up to almost break even for the week. But that tends to happen when you have such big down days on a Monday. And we'll see if that pattern plays out going into next week. Let's take a look really quickly at the Dow Jones Industrial Average. You can see it also has a bearish posture with dark pink shading, dark red line. You look at the NASDAQ Composite. You can also see dark pink shading, dark red lines. We're falling below the moving average. Relatively bearish short-term sentiment for all of these. And the Russell 2000, which has been the laggard, right? It's also now got the dark pink shading and dark red lines. So they're all... we talked about the correlations tend to move towards 100 when everything's selling. Well, everything's selling right now. You can, if I were to take a look at the sectors, and we'll take a closer look at this here later, but just to kind of give you an idea, when there's sell-offs, you can look all across these numbers. Pretty much everything sells off. Sorry, I'm in a hotel, so the internet's not as fast, so it takes a little bit of time to load up. But you can see how everything falls. And when we get to the end of rallies, then you don't have that same phenomenon. So we were actually, our correlations, if you recall from a couple weeks ago, or about a week ago Friday, I updated the correlations on our blog. Give me 1 second to find that here. Here we go. From a couple weeks ago, you can see that even just at the end of July, we weren't quite to that point where we had lots of green and lots of white, which means we have little to no correlations or even negative correlations. They were all red, which means that the correlations between the sectors are all 75% or higher. So, and orange is 50% or higher. That's a lot of red and orange. That's only going to get more red and orange here as the markets sell off again. That's actually a sign of how bearish we are, and that kind of shows, again, when you don't look at this as a sign that we're overly bullish necessarily, and obviously we're not overly bullish anymore now, but we weren't then either, and we're getting buying opportunities now that we didn't have a week ago because of where the pricing is at for most of these sectors and the stocks within those sectors. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this little subscribe button right here. That will subscribe you and notify you when these videos are posted. Also, click this thumbs up icon. That lets us know that you like the video and you want us to do it again tomorrow. Quick, easy way to give us feedback. You can also comment down below on any what you got out of the video here today. You can also subscribe to our email list. There's a link right here. Just click on that more button in our description. You can subscribe to our daily market outlook email list. Click on that link. Follow me on Twitter for more content like this throughout the day. In between the videos, there's a link to today's market outlook tweet on Twitter, and join our market outlook community that we've created here on Facebook. The link right there. Also, if you're watching this in our blog, we invite you to subscribe to our website at marketscholars.com. You can do that for free. Click this little blue button up above at the top of the page, no matter what page you're on. You can see the services that we provide at Market Scholars here by using this link, services, that will take you to all three of our different levels that we have, including our free option, and our plus and our premium, that can be paid for either monthly or yearly there. So make sure you go check that out. We also invite you to engage with us on social media. We're having a little bit of an issue with our Twitter link, as I showed you. If you go to my Twitter feed at DavidSettle42, usually tonight's market outlook is posted at the top there. If you just click on this like button, we got over 125 last time, so that's a nice good number. It's one of our highest numbers we've had here. Again, the more you like and retweet these videos or anything that we put out there on social media, whether it's on Twitter or even on Facebook, if you click this image, it takes you to tonight's market outlook Facebook post. The more you engage with us there, the more they'll keep pushing you all of our stuff in your timeline. So that's why we try to make it as easy as possible for you to engage with us. All right, back to the charts. If we take a look at the long-term chart, you can see we had a transition candle last week. So with how we finished last week, it turned the Hakinyashi candle into a transition candle after 7 up weeks, and then here's our one big down week. And that, you can see that can happen. We had a little small transition candle there, and then whammo. And in February of 18, we had a little small transition candle there, and then whammo. And in October of 2018, and both times getting down to the 200-day moving average. Here took about 5 weeks to get down, well, 4 weeks really, to get down to the 200. And now, one small transition candle, and then whammo, we're right back down to it. And you can see the momentum is declining. In fact, if you take a look at the rate of change for the S&P 500, it's actually down to its one of its lowest levels that it's been since that October decline. So for one of its lowest levels of the year that we've had in 2019. So pretty bearish returns. We were already relatively bearish as it was in terms of having lower numbers there on the rate of change, and that's just going to get bigger. I mean, depending upon where we close tomorrow, we might pull down towards this 5% level. Which in the past has been, absent of these big death cross. See, these are all death cross environments, right? Where where the 50-day moving average crossed below the 200-day. You can see we're not in that mode, at least not yet. We're not in that mode right now. If I were to go back to just the regular candle, we're sitting on the 200-day moving average, but the 50 is still on a relative basis still pretty strongly bullish relative to the 200-day moving average. So I mean, it doesn't look as big considering the logarithmic scale we got here. But when you put it on this PPO down here, which looks at it relative to the value of the 200-day moving average, the gap between the two lines, it's still relatively high. So, we're not quite there to a death cross environment. And you can see how we were grinding away before we got into the 2015 death cross environment. And even over here in 2018, we were right about at these levels after that first week. And then that first, this first drop in October, was a matter of whether or not we were going to actually hold this this level here and pop back down. We eventually did after some really wild ups and downs around the 200-day moving average. We eventually did with the declines in December. So again, when you're this bullish in terms of momentum, to close below the 200-day moving average usually as a signal, a reversal signal back to the upside, at least by the end of the week. And we'll see, again, we're only one day into this week, so we'll see how we finish off the week considering how bearish we have started the week. Let's go to the 3 green arrow charts for the S&P. Not surprising, we have a tremendous range relative to the average, and you can see that negative 3-month return there. Obviously, we have 3 red arrows. If you take a look at the 2-line versions of both those oscillators, the MACD is well below 0. Stochastics is in its lower half of the chart as well. You can kind of see how we're almost to that same levels we were back here in May, well below the 8-day moving average. If I were to change this MACD to look at the current price relative to the 8-day moving average here, just to kind of give you an idea of how bearish we are. Today is as bearish as we were back at the end of December, and also here in October of 18. So that kind of, we diverged. We had a divergence low point eventually there, and that ended up being a V-bottom low point in December. But this is a lot more bearish than we were ever in May or June of a decline. In the range today, keep in mind too, if you look at SPY especially, it's a tremendous range relative to the average, but you also have to keep in mind there's a gap in there. So we closed at 292.62. The high was 288. So that's a about 4.25 point move on top of this range. So you're looking at about over a 10.5 point range when you include that gap. That's an extreme, more than 5 times. That's a lot of volume there, and you can see a lot of trading range, and the volume, of course, at 178 million shares trading hands today is the biggest amount of volume that we've had since these December lows when we were at 250 million, 214 to 215. We also had about a 200 million day over here in early December, the last time we had the significant trade issues with China. So here, give me 1 second to pull this up here. All right, now let's take a look at the intraday chart. The intraday chart, you can see obviously dropping into the lower half. So we held the lower half of the 4-week range last Friday. Now we are well down. That wasn't the lower half. We were down. We actually had 4-week lows last Friday. So what that is now the midpoint. Fridays, so as bearish as we were today, it's about as bearish as we were coming off of the highs, the all-time highs there last Friday, the previous Friday, and then most of Monday, Tuesday, and Wednesday before things really started to hit the fan after the FOMC on Wednesday, and then especially on Thursday and into Friday, and obviously over the weekend. So, in fact, that's about a we went from 3 on Thursday there, when the 10% tariffs were announced. We went from 300, essentially 300 and a half, now down to 281. So almost a 20-point drop on SPY that quickly and with that much volume to the downside. Again, to put that volume and trading range in some perspective, I mentioned the 10-point range and the 178 million volume. Let's look at that in comparison. 178 million is way up here. The 10.5-point range is also way up here. The ATR now is over 1%. That 1.5, especially getting 2%, that's when you really start to get concerned about a significant bearish decline, like a long-term bearish decline. To have that big of a decline and that much volume tends to be pretty extreme, and you can start looking for some opportunities on those extremes, especially considering, again, we're down to 270. Well, where are we at now? 279. Well, we're up a little bit now. 279.09. You look at the futures contracts, and you can see that 27.93 now. But now when you have that big of an extreme, see, it's the 100 to 150 million. It's the 5 to 6. It's the consistent declines that you worry about, right? All these down days, they're not out of the ordinary. We had one big move, as you'll see here in a second, with volatility, kind of a surge in volatility, and then this is a bunch of just strong, consistent moves that bring the averages up, but not unnecessarily extreme like today was. These kind of days can set low points, similar again to what we saw back in August of 2015. If I were to go back here to, again, that August time frame, we'll go 2015, and we'll go here 12/31 of 2015. The last time we've had these issues, right? It was right over in this area, this 20th, 21st, and into the 24th. There's that Monday that was so bearish on the August the 24th. Well, that set the low point. That was such an extreme move. That was a 15-point range there. No gap, right? 15-point range, and a tremendous amount of volume spiked things up, and we were already declining going into that. Well, that sets the low point, and then we have some volatility into that range again, but we go off of that low before we have another death cross, and that, remember, that was a death cross too, which makes that even more bearish than what we see right now, because by the time we were in August, 21st and 24th, if you take a look at the weekly crossover over here, let's go back to a Hakenyashi. So that week before, the week that ended with the 21st, that's how far below the 200-day moving average we already were. And again, we're just getting to that point right now on this bear. See, this Monday was this hammer pattern here. This is this Monday here. So a little different situation, whereas last week we were just barely crossing the 50 with strong momentum. Over here in August, we had crossed below the 200 with momentum close to zero. The 50 almost crossing below the 200-day moving average before that really significant bearish Monday. Let's take a look at volatility here really quick. Volatility had to jump up higher, not surprisingly, up above 20. Got up to 20 last week, and now has gotten through 20. So we got above 105%. 115% is the surge levels, right? That's the levels where it will take a while for it to recover from. So October we closed above 115%. December we got above 115%. It took a while for volatility to get back down and get into the bullish zone when you surge up that high. Over here it never did, and then it surged up again in December, and then finally we were getting in by April, March, we were getting into the bullish territory. And we had a little bit of a jump up, not up to 115%, but up here. But you see the long upper shadow. So unless we really, close the weeks, at the high in volatility, which is not uncommon, but if you take a look at the weekly chart here, you get lots of long upper shadows on weekly charts. You get a lot of volatility early in the week before things settle down. So we'll see if that ends up being the case here, similar to what we saw, back here in October, or even even here in May of this year, where we got that initial surge. We had an intermediate pullback, but not necessarily a market sentiment pullback here. So I expect we'll end up with some type of shadow here this week as well, which means we could even move up a little bit more in volatility before, by the end of the week, things start to settle back down. And this settles down relatively quickly when you get these big moves, quick moves in volatility. All right, now let's talk about what's driving this action. And of course, we all know, right, what's driving this action. It's this currency/trade war that the U.S. and China are engaging in. It's a tit for tat, essentially. Trump over the U.S. administration, on Thursday over the weekend, saying that they're going to slap on more tariffs by September on Chinese goods. China retaliates over the weekend by letting the yuan depreciate through a significant level, and also adding on that they're not going to buy agricultural products. And then now the U.S. labeling them here in the evening today, currency manipulator, and all that entails. So things have kind of been taken up a notch, so to speak. An old Seinfeld reference there, between the U.S. and China. And that's resulted in a flight to safety. And you have long-term bonds up 5.5% over the last 2 weeks. You have gold up 2.5%. Here you have the dollar pulling back since Thursday morning. So if I were to look at the last few days here, so let's go to August. We'll go to Thursday, Friday, and today. So the last 3 trading sessions where things have really significantly fallen. Of course, Thursday started off, this is coming after the FOMC, right? So the stocks had bounced up 1% before pulling back by the end of the day and closing down 1%, just about 1%. And then, of course, Friday's move and then today's move. So in those 3 days, the S&P is down 4.5%. You can see emerging markets are down 6.5%. Small caps. You also see crude oil dropping significantly, down 5.5%. High yield bonds holding up relatively well, but you see the dollar is down a full percent. In fact, and then there's bonds and gold up there. If you take a look at the U.S. dollar on a daily chart here, after having broken through this significant 98 level, and that was a level that we were kind of been watching for. I talked about it in the webinar on Wednesday night. The question was, will this hold? That's the breakout that we had on Wednesday. Will that hold? And I've been really skeptical of the dollar holding any of its breakouts above that 98 level. And you can see the move that it's had ever since. It's continuing. There's where it's at here today, so far down to 97.23, so down even more than where we closed here yesterday at 97.39. So the dollar is changing directions here. Ultimately, that's not a bad thing for stocks to see the dollar depreciate, and some would argue from a political standpoint that's what the administration has wanted. Of course, that's going to have its impact. Declining dollar will have an impact, especially on gold prices, which have been really bullish already as it is, and they're really extending away. In fact, if you take a look at the linear regression for gold prices here, you can see we are outside of two standard deviations on gold for this 1 year period. That's a significant move on gold. On the other end of the spectrum, crude oil has got a declining linear regression. So that's a bearish, continuing to roll over and be bearish. If you look at its market forecast chart for crude, you can see it's got the dark pink shading and the red line. It's going to be highly correlated to equity, so not surprising to see a similar pattern to what we're seeing on equities, whereas gold is this extremely bullish. You take a look at the 10-year yield, and there's a lot of people paying attention to the 10-year yield. Remember, the overnight Fed funds rate was lowered down to 2%, 2 to 2.25% range. Because of how low we were, the Fed had tried to catch the overnight rate down to the 10-year note because of this. This is the yield spread. Now, this isn't updated. Let's see, when was the last time this chart was updated? Let's zoom in as much as we can here. This is updated, looks like, as of the 2nd. So this is going through last Friday. You can see even with the Fed rate cut, we were still negative on the 10-year, being minus the Fed funds rate, and that was before today. So today it's even worse, and that's why you're seeing here the expectations. Here, let's bring up the CME. The expectations for a rate cut for 50 basis points rising in September. Give it a second to load up here. There we go, rising up to 44% from being just on Friday at 1.5%. So, that's really strong odds for a 50 basis point rate cut. Of course, by the end of the year, you've got a 100% chance of another rate cut and a 94% chance of getting 2 more. And then, of course, the inverse of 36 would be 63% chance, so we'll get a third. So you're getting high probability, not baked in, but a high probability that we're going to get 3 25 basis point cuts, even if we get 2 and 1 meeting. But we're getting a high probability, not baked in, but a 60% plus chance, so we'll get a third one by December. Of course, looking out to April of next year, we've been paying attention to that. 100% chance, 98% chance, or 100% chance of at least one. That's obviously going to be in September. A 98% chance of getting a second one, an 85% chance of getting a third one. But then after that, the odds start to drop down. So you're looking at 43, 45%, so about a 55% chance of getting a fourth one. So again, the markets are still kind of wary about looking at a regular pattern of 1, 2, 3, 4, 5, 6 cuts. They're looking at, okay, we're getting a lot of volatility right now. The Fed's probably going to really kind of blow the door open on some cuts and then kind of go at it a little bit at a time to see what's going on and potentially getting, that like I said, a 50 basis point cut in September. And then a high probability of another cut by the end of the year into December. So that's what's dropping this down. Again, it's the 10-year note now that's down even more today, bringing this down to that 50 basis point level below the Fed funds rate. That's why you're seeing these odds ramp up so much for the Fed to really start catching up to that. So it's not... I don't think necessarily it's a political thing. I think the market is dictating to the Fed what it needs to do. The Fed needs to, the Fed worries more about deflation than it does about inflation. And when the 10-year yield, if you look at the 10-year yield right now at 1.76%, and again that's, it's at 1 point. This went down to 1.73%, and I'm going to venture to guess it's probably going to be even lower than that. The futures are up a little bit more today in the after hours, up 0.25% here. So, these rates going down as much as they are. If you take a look at the dividend yield for SPY, is over 2%. A little bit of a bounce continuing in the after hours. So you're getting a better yield right now on the SPY than you are on a 10-year Treasury bond at a relatively low level too. For the S&P 500. From an economic standpoint, and I know that hasn't been the focus. Obviously, it's been on China and their currency depreciation. But from an economic standpoint, you can see that ISM non-manufacturing is down, a little bit here, down to 53. From an economic surprise, when you look at all these indicators put together, it's still relatively negative, but not nearly as negative as they have been. Of course, GDP estimates, when you take into account all these different factors, were updated on Friday, and we're at, for the next quarter, at 2%. So, and you recall again that we were just right about at 2% for this last quarter, and that was despite a 1% decline in inventory growth. So, from a fundamental standpoint, we haven't had a significant change. Again, a lot of this volatility, we know where it's coming from. And, volatility that is more temporary like that can end up producing temporary results in the short term on the S&P. And you have to look at these opportunities, look for these opportunities to take advantage when you can. I'm going to venture to guess a lot of stop orders are being triggered with these declines. That frees, on one hand, it triggers stops and triggers realized losses. On the other hand, it frees up capital for you to be able to use now elsewhere and finding opportunities to look for bounce backs here. So during the decline, again, with the rise in the long-term bonds and the significant drop in yields, that's helped utilities and real estate actually hold up. So despite a 4.5% decline, you see utilities are only down 0.5%. Real estate's only down 1%. Staples are only down 3%. Basic materials, which has an element of gold to it, is down 3.5%, whereas technology and energy and financials and industrials, all these cyclical areas, really dropping the worst during these declines. So very cyclical move to the downside, but keep in mind, that 200-day period that I like to show you. Again, that never really got to the point where we had significant oversold conditions. Sorry, October 17th, 2018. Never did get to the point where we had significant cyclical overbought conditions. You can see how technology had made its way up into this area, but now you can see that despite, again, the S&P is up 1.25% over the 200 days. The utilities are up 10%, 10.25%. Staples are up 8.25%. Real estate is up 17.5% already. So this isn't, again, a lot of times you'll start to see these areas start to pick up, and you'll have the red line and discretionary, the orange line, and other cyclical industrial financials up at these high levels, and they'll start pulling back. This isn't the most bearish chart to see these areas, at least bearish going forward from here, to see such significant outperformance already in these safe haven sectors heading into this current bout of volatility that we've had. If you take a look at the relative rotation, obviously energy has been our biggest decliner, with the weakest relative strength. Had been gaining some momentum, but still hasn't crossed above zero yet. You can also see too, here's utilities was losing some of its momentum heading into this week. Real estate also losing its momentum, and then finally staples. So they had been strongly bullish, and relatively strongly bullish compared to their peers. There's XLK, which had been bullish and still continuing to show relative strength with a pickup in momentum. That was on the weekly chart. Of course, on the daily chart, things look a lot different. There we go. Now you can see XLK is losing its momentum, and then there's real estate, utilities, and staples. Staples right back into the daily chart. You can also see XLC. It's really been jumping up higher as well and moving into that leading area. So your XLK still got the highest relative strength, but with a significant drop in momentum. You can see XLF and XLC also with relative strength still, but you've got some areas picking up speed quickly. All your safe haven areas picking up speed, but they've been relatively bearish to the downside here. So are they going to be able to cross above 100 on the relative strength before by the time we bounce, or are they going to roll over and lose momentum before they cross 100, or just barely crossing above 100? This is what that chart looks like if I were to show you, for example, the real estate chart here. Open in a new tab and take a look at its relative strength chart down at the bottom. Here. Update that. And you can see there's the chart, and there's how bullish we've been. It's on a weekly chart, mind you, but let's go back to now a day. And that's why it looks like on a weekly chart we're losing relative strength. We had such strong relative strength at the beginning of the year. We've been gradually losing with a loss of momentum here, as it looks like we've been peaking. That's on a weekly chart. On a daily chart, you can see what it looks like here. I mean, we were pretty bearish today. It was down today. So you can see the candle. It was down today, just not down as much and well off of its lows. its momentum is picked up to the positive side. Its relative strength is also picked up to the positive. The question is, how bullish will this get during this? While the relative strength has been declining on the versus the S&P on the weekly chart, you can see it has ups and downs, and right now we happen to be in the period of bullishness, and this is about as bullish as the momentum has gotten in the past. So, again, this is a nice little pattern of relative strength for the real estate and utility sectors on an extreme bout of volatility. I don't necessarily think that we're heading into a long-term bearish move where I want to park a lot of my money into these areas. Not yet, at least. We haven't had the significant outperformance yet in the cyclical areas that would suggest that we're now headed towards a more longer-term pullback. In fact, as I mentioned before, it's a little scary that we haven't had a more underperformance in these cyclical areas or in these safe haven areas that would allow them the ability for people to rotate into them. They've been so bullish, not just XLRE, but also XLP, XLU. They've been so bullish here. This is all 2019. Look how bad XLP performed today. This is on that's a 10-40 week moving average, but that's a significant drop to the downside because it's been so bullish. It's not able to act as well of a safe haven as it could have been if it had bigger periods of underperformance previously. All right, so for our trade idea of the day, I saw something on TV from Downtown Josh Brown. Some of you may see him. He's a contributor there, and he had some really good discussions. It was early this morning while we were looking at it. We had come back to the room. I was checking out on TV. He was talking about this idea that you want to look for these opportunities where you can get filled in at prices that you just haven't seen. These he called obscene prices, using buy limit orders to get filled in on these pullbacks. For example, a stock like this, like Visa. It was so bullish, and we had been up so much on a strong trend. It got up to 184, obviously down as much as it is now. Still up on a one-year basis 20%, and on a year-to-date basis 28%, despite the decline. But as you can see, it's starting to pull back down. There's some significant support down in these areas. Not as nearly as much volume where we were. That's why we dropped so fast. But if you can get filled in at 160, with a buy limit order here at this last support level at 160. There's an opportunity, especially with a little bit of a dividend yield. Now, granted, its dividend yield is not very high. It's a relatively low dividend, so I wouldn't bank too much into that. But if you can sell that 160 put for $300, requiring in this account at least $2,500 to get that, it's a little bit more than a 10% return here on that stock. Being willing to lose $300. So if I were to analyze this trade, go to the risk profile, and we'll take a look at how far down we can let this thing go. And you can see we can go all the way down to about 160 and a half. As of today, of course, as time passes, you'll notice that that 300, like for example, if I were to wait another week, plus that $300 is now roughly 159. So we can pull back. It gives me some room to work with. There's some support down in that area, and that's how much I'm willing to lose for this relatively high probability. I set this slices at break even there. Let's reset these parameters. A relatively high probability trade of getting more than 10% return. And if I can get filled in at 160, and I want to own the shares of the stock, then you have this opportunity. You can see you've got a 3 red arrow signal as we stand on Visa with a high spike in volume, a really significant spike in volume on that 3 red arrow signal. So we'll see if that ends up setting the low point here for the stock. You look at its Ichimoku cloud, and you can see that it had broken below the blue line on the Ichimoku and is hitting the cloud for support, and it did this last time. We had a nice little rally off of this. You can even look at selling that put with the opportunity to buy an option, buy an out of the money option here for the same amount of money $320, and for 180 put, of course, that's well out of the money. And for October, how far can this stock go up through by October? Well, even in September, you can get up to 180, beyond $180, $186. So you can still get a pretty decent return on that far out of the money because of where we're at. Remember, the high point we were just coming down from is about 184. So, there's a pattern like that gives you an opportunity to be bullish. And if you can get in at 160, you might be able to get at a price that you wouldn't have thought about getting just about a week or two ago. And that's the kind of mentality you look for in these types of moves, especially on a stock, that's made such a big move, not only from a volume perspective, but also from a Bollinger Band perspective. See how significantly low that Bollinger Bandwidth is compared to where we've seen in the past, right? Back here in October, that kind of set the low point when we were that bearish. We eventually broke below a little bit more in December, but on that last little hurrah, but that essentially set the low point there. If we go down a little bit more, we might be able to get into a price at support that, like I said, we haven't seen for a couple of months. That will be a much better price than getting in at 185 if we were to continue to ride that trend. So obviously this is one individual stock, but there's going to be more and more of these types of trades out there over the rest of this week, for that matter, as the market tries to hammer out a low point, a bottom this week. All right, that does it for today. It's a little bit long video, but we had a lot to talk about with the technicals and what to expect and what we can do with the type of volatility we got over the last few days and so far overnight tonight heading into tomorrow. So I'll get back to my vacation here. We'll be coming home tomorrow, so I'll be back to my regular classes on Wednesday. Remember, Brandon teaches tomorrow his dividend growth investing class. That's part of our monthly subscription, our monthly plus subscription. So if that's something that you're interested in, if you're looking for how to take advantage of this week, make sure you hit that class. And then the other class involved in the monthly plus subscription is my technical analysis class on Friday. So we'll talk about how the week ended up and what we can expect to see going forward from there using technical analysis. And of course, if you get the yearly plus subscription, then you get the additional options classes. And that's going to be a big focus of my next week when I get back. My directional options class, looking for plenty of opportunities on a pullback like this. So again, thank you very much for watching tonight. I appreciate your time in watching these videos. Have a great rest of your evening. Remember to click that like button, that thumbs up button on YouTube, subscribe to our channel, comment on the video, follow us on Twitter, and join our community on Facebook. And we'll see you all next time. All right, goodbye, everybody.